Okay, 15:01, I suggest to get started. A very warm welcome to this DCED webinar. Today, we will present the study Narrowing the Gap, Business Environment Reform and Private Capital Mobilization, developed by the Business Environment Working Group of DCED. My name is Tobias Fleckenstein, and I work as a policy advisor at GIZ, and it's my pleasure to moderate today's session. Let me start by introducing our speakers. We have Philip Walker, who is a senior advisor at the Center for Development Finance Studies and the lead author of this study. We also welcome Yasser Karafi, who is Chief Investment Officer at the International Finance Corporation, IFC. He will share a case study from the Scaling Solar project implemented by IFC in Zambia and Senegal. I would also take this opportunity to extend my thanks to the entire task team that was involved in developing this study, including colleagues from the World Bank, IFC, the OECD, SICO from Switzerland, and GIZ. They all provided valuable input and guidance through the development of this study in the Business Environment Reform Working Group. Before we begin, I would also like to share a few logistical notes. Please feel free to introduce yourself in the chat. And as the session benefits from your active participation, we encourage you to submit questions and comments. Please use for any questions and comments the Q&A box located at the bottom of your screen. There is a chat box for introduction and a Q&A box for questions and comments. You're also welcome to raise your hand if you'd like to ask a question verbally. And now, without further ado, I hand over to Philip. Philip, the floor is yours.
Thank you very much, Tobias. Hoping you can see the presentation on the screen. Thank you. Well, look, welcome everyone to this webinar. It's a real honor to be here. In 2025, the Donor Committee for Enterprise Development commissioned the Center for Development Finance Studies to prepare a report on how business environment reform can more effectively support private capital mobilization. Key topic for our times. And this webinar has been put together to discuss the findings of that report, narrowing the gap, business environment reform, and private capital mobilization. Before I start, I'd also like to, thank the Donor Committee for Enterprise Development on behalf of the Center for Development Finance Studies, and in particular, the Business Environment Working Group for their trust in us and support in putting together this report. Including GIZ, the World Bank Group, OECD, and SECO. Thanks also to the interviewees who contributed valuable insights, ACT, IFC, GIZ, KfW, and embassies of Switzerland in both Vietnam and South Africa, as well as the World Bank Group. And then, of course, thanks especially to Tobias, who's led the coordination throughout. So just a way of reminder, on business environment reform and what it refers to. And it's really the process of improving the laws, regulations, institutions, and policies that govern how businesses operate, invest, grow in their national context. And the objective of BER, or business environment reform, is to create a more transparent, predictable, and efficient environment that lowers barriers to entry, reduces costs of doing business, and encourages entrepreneurship, and ultimately attracts private investment. While the theoretical logic of business environment reform and mobilization is really compelling, the actual implementation often reveals complexities. So real-world evidence indicates that there are significant limitations and challenges that disrupt or dilute intended outcomes. So reforms often threaten vested interests or require politically sensitive changes. and a lack of political will or instances of leadership turnover can stall or reverse progress. And even where legislative change is achieved, implementation challenges such as inconsistent enforcement or bureaucratic inertia or lack of capacity can substantially limit impact. And while business environment reform can reduce friction and improve risk return profiles, it can't fundamentally alter the underlying attractiveness of investments in absence of favorable market conditions. Something really important to remember. So standard reform models often fail to reflect local realities, sector dynamics, or informal market structures. And so one size fits all approaches simply don't work. What works in one context may not translate without proper adaptation. And finally, measuring the impact of reforms in the years after program completion is methodologically difficult and resource intensive. So quantifying business environment reform outcomes presents significant challenges that complicate assessment and adaptation alike. So despite many years of efforts, um, it is difficult to demonstrate an adequate return of investment or adapt in real time, to business environment reform. Nevertheless, the strategic imperative remains strong. So despite the implementation difficulties of business environment reform, there's evidence across the development community that show that well-designed business environment reform interventions can, when properly aligned with market opportunities, political realities, can significantly drive private sector activity and investment. And given the evolving landscape of development aid and the context in which we find ourselves today, the significance of mobilizing private capital has never been greater. This study, it draws on a multi-pronged evidence base to explore how business environment reform can most effectively support private capital mobilization. The approach combines semi-structured interviews with over a dozen practitioners from DFIs and development agencies, providing real-world insights into the challenges and success factors linking business environment reform or mobilization. We undertook an extensive review of literature from knowledge generation leaders on business environment reform. And we undertook some case study analysis to illustrate how business environment reform interventions have, under certain conditions, successfully mobilized private sector resources. The selection of the case studies that we put together favored climate resilient sectors to the extent possible and sought to illustrate precedents across various geographies, predominantly middle income countries where there's been more successes. So I'll just start briefly with South Africa, which is a strong example of how crisis can catalyze reform and mobilize private capital. So as you know, the country faced severe energy crises with load shedding reaching up to 10 hours per day in 2023, reducing GDP by over 3%. The underlying issue was structural. So a vertically integrated monopoly, weak governance, rent-seeking behavior, and years of underinvestment. So in response, the government implemented a two-pronged reform strategy. Firstly, unbundling and restructuring Eskom. We unbundled generation, transmission, and distribution and created an independent transmission company to ensure fair grid access. And secondly, they opened up the market to private investment. So accelerating licensing for renewables, removing generation caps to enable corporate power purchase agreements. So crucially, these reforms are backed by strong political commitment, including a dedicated Ministry for Electricity. What makes this case really compelling is how political alignment needed for reform was directly linked to the financing. So development partners, the World Bank, the African Development Bank, KfW, GIZ, provided a coordinated budget support tiered to and tied to reform progress. A key instrument was a $1 billion World Bank development policy loan where disbursement depended on actual reform implementation. So the financing didn't just support the reform, it enforced it. And the results have been quite significant in terms of the increase in private investment, um, embedded generation that's scaling rapidly, and transmission infrastructure expanding. Challenges remain, but it's essentially, this is a massive unlock in terms of a loan that together with the prevailing business environment and political will helped essentially create an enabling environment for more private capital mobilization. If we turn next to Vietnam, this is a contrasting case, less about crisis, more about a deliberate sequence reform. So this country set ambitious climate targets under its green growth strategy, with financing needs of more than 400 billion by 2040. Mobilizing private capital became central from the outset, and what stands now is how carefully reformed sequence reforms actually helped create the market for this. So Vietnam started with market foundations, essentially, firstly, a green taxonomy defining what qualifies as green investment aligned with international standards. Secondly, ESG disclosure frameworks, which became mandatory for listed companies, and guidance for bond issuances, improving transparency. Thirdly, market infrastructure, including ESG indices and pilot reporting systems. Only after establishing these foundations did Vietnam move to financial instruments like green bonds. So here we can see there's a long-term coordinated engagement from IFC, the World Bank, GIZ, and SECO, providing technical assistance. And the results have been over 500 million in sustainability-linked bonds issued and a 30% increase in ESG disclosure, as well as strong momentum in the sustainable finance market. Together, these two case studies show how there's no one-size-fits-all approach, but in both cases, well-sequenced business environment reform aligned with national priorities was central to unlocking private capital at scale. The next case study, which is scaling solar, I'll only just briefly mention that this was part of the study, and we have a guest speaker, as mentioned by Tobias, who will present later on this topic in more depth. Climate resilience is the next frontier for business environment reform. We're currently facing a massive gap of around 2.4 trillion per year by 2030 for emerging and developing countries. That's roughly 6.5% of global GDP. And so a key challenge is that climate adaptation and resilience investments are fundamentally different from what is typically financed through private capital. It tends to be longer term and harder to monetize, and often have strong public good characteristics. So unlike mitigation, where you can generate revenue through energy or carbon, adaptation doesn't always provide clear cash flows. And this leads to an important point, which is that standard business environment reform tools are not often well suited to the challenge of climate. And so if we want business environment reform to play a role in climate resilience, we need to rethink the approach. In particular, legal and regulatory stability needs to be provided across longer term cycles, because investments in climate are longer term and investors need the confidence that policies won't shift. And so essentially climate resilience pushes business environment reform into new territories. We need more tailored, more stable, and more innovative approaches if we want to mobilize private capital for climate specifically. So let me just jump into a few takeaways before we go into recommendations. Our conclusions from the case studies were that essentially, firstly, business environment reform is necessary, but it's not sufficient. So it plays a critical role, but on its own, it won't mobilize private capital at scale. So the question becomes, when does it actually work? Um, and from our study, our findings are that essentially there's a need for three conditions. First, it needs to be anchored in real investor demand. Reforms have to be respondent to what investors actually need, not what we assume they need. Um, Secondly, it has to be politically feasible. So even if technically strong, reforms will fail if they don't align with domestic political realities. Um, and thirdly, it needs to be properly sequenced and adapted to the local context. So there's no one size fits all model. Timing and tailoring are really critical. So real impact happens at the intersection of these three elements. And finally, this has implications for DFIs and MDBs. Their role is not just to provide capital, but it's to act as facilitators in this system. And so our first recommendation is to ground business environment reform in local needs. Um, it's simple but often overlooked. Reforms can't be designed in isolation. Too often we're still in this kind of top-down or based on global best practice mindset and not really grounded in what local investors actually need. Many of the interviews that we undertook really underpin that. So the starting point needs to be on domestic actors. So, involved in discussions with local banks, pension funds, business associations that understand the real constraints. And equally important in this recommendation is creating continuous feedback loops. So ongoing dialogue between public and private sectors. Vietnam, for instance, is a good example here. Their ESG reforms worked well because they are just real market barriers and not theoretical ones. Our second recommendation is to align reform with political will and capital demand. So reform only works where two things overlap. So there's strong investor demand and political feasibility. If one is missing, reform tends to stall. So that's why tools like investor mapping and political economy analysis are important, and they help identify where that overlap actually exists. But it's more important than that. It's essential to go and target markets where we can actually find alignment. Um, South Africa provided a great example of that. The energy crisis created both a political urgency and strong investor demand, and that alignment created the space for reform to move quickly. Um, Without, I think, the urgency, on the political side, it was very difficult to move, which essentially the tool that was used, which was reform linked financing, was critical to unlock the situation. Recommendation 3 is to work on purpose-built business environment reform for climate resilience. As I mentioned, we need to recognize that climate resilience is a different type of investment challenge. The barriers are unclear in terms of returns and regulatory frameworks. So traditionally, business environment reform approaches won't be enough. So we need more purpose-built solutions and new financial instruments that reduce uncertainty and improve risk return visibility. Resilience bonds, for example, and disaster risk insurance are some of the types of instruments that can be used. Our fourth recommendation is to integrate policy with investment practice. So, we noticed that there's too much of a gap between many of the different players within the development finance community. We need to bridge the gap between policy and investment reality. So too often the upstream policy teams and downstream investment teams operate in silos. So what happens is reforms look good on paper, but don't actually unlock the capital. And there needs to be stronger collaboration between the development banks and the DFI transaction teams, because ultimately the DFI transaction teams are often the closest to on-the-ground real bottlenecks. And they're best placed to internally even inform, how capital actually flows, and how we can actually address some of the key issues in our local markets. And I'll stop there. Tobias, over to you.
Thank you very much, Philip. That was very insightful. Would like to take the opportunity to remind you for asking questions, sharing comments in the Q&A box in the Q&A section at the bottom of the screen. And with that, I hand over to Yasser for the solar industry example.
Thank you, Philip. And actually, in my presentation, I think I will illustrate or hit on some of the points you highlighted in your presentation. So if we can move to the next slide, please. Scaling solar literally came about at a time where I was actually posted in Africa, in Dakar. And I remember the timing pretty well. I had just come out of a meeting with the Minister of Energy in Senegal at the time. We're talking here about 2014. And where the minister had asked us whether they should be engaging into discussions with developers that were promising them to do solar PV in Senegal for 18 or 20 cents per kilowatt hour. And I remember being a bit taken aback, because we were already seeing that those price levels were actually much higher than what we were seeing elsewhere in the world. And so I came back to my desk, spoke with a couple of colleagues, and then we had this kind of nagging question, which was, why can't we see, or can't we get the same investor that we were seeing investing in solar PV in Latin America, in India, in Asia? Why aren't we seeing them investing and coming to countries like Senegal and Africa, sub-Saharan Africa more broadly? Because these are the guys that we need. And these are the people that we need to come to invest and offer something which is compelling, both from a technical, but also from a financial perspective. And so this is how scaling solar came about. It was a response to a well-defined problem. And that problem was, how can we attract competent private investors in Africa so that they can deliver solar PV on time and at reasonable cost? And we felt that Africa had quite a lot going for it at the time. You had excellent solar endowment, the need for electricity was there. Actually, believe it or not, but in many countries in Africa, electricity tariffs and cost of generation were very high, because in many cases, those were based on HFO, heavy fuel oil, or diesel, and those cost a lot of money, believe it or not. And so we felt that the opportunity was there. And so in thinking about a potential solution, we started with some key principles. What does work elsewhere, and that we should be focusing to try to bring to Africa? And so obviously, we wanted competitive and transparent procurement, because we felt that bilateral discussions, in some cases, they have value. In some cases, you have no other option, but they should be the exception, not the rule. And by having competition, you would be able to both bring the people that are serious, that behave ethically, and that want to do things properly. Believe it or not, a number of private investors, for example, would absolutely want a process that is a competitive process. They would not just engage in bilateral discussions. Not all of them, but some insist on having a competitive process. We wanted this to be standardized and balanced, meaning that we wanted something that was protective, but protective for both parties, equally the governments, but also the investors, because unfortunately, in too many cases, I'm hearing that there is an echo. Is the sound okay? No? Okay. So unfortunately, in too many cases, what you see is that you have unbalanced contracts, and meaning by unbalanced is that in some cases they're too much in favor of the private investor and not necessarily in the interest of the government, or the opposite. And so we wanted to have something where standardized and balanced. We wanted to provide competitive financing, and more importantly, we wanted this to be a packaged approach, because we were very mindful that if you are a policymaker sitting in a government in the energy sector somewhere in an African country, you literally had a lot on your plate. You had a lot of issues to deal with, and your life was already quite complicated as it is. So we needed something that was simple. Next slide, please. And so in a nutshell, what we tried to come up with in scaling solar was simply a full integrated suite of products and instruments that covered everything, literally from project preparation. And by project preparation, we literally mean identifying sites where you would go and build those solar PV plants, all the way to supporting the host government, all the way until the end of construction and start of operation. And the idea was to offer them a single package. They only have to sign one agreement, and then everything else would follow, because that was also something that we were seeing quite a lot at the time, is with many development finance institutions, with many multilateral banks, with many donors. In some cases, governments and decision makers in governments were literally assailed by multiple propositions from multiple parties, and in a number of cases, this simply led to paralysis. So the idea was really to offer this single package overall. We sat together with colleagues from the World Bank, from MIGA, from a number of people from the IFC. We also held extensive consultations with colleagues from other multilateral development banks and institutions, because we were very mindful that we need to create a positive coalition around that. And once we felt that we had the key building blocks, we started engaging with governments across the continent to try and discuss with them this solution. And we were lucky enough that relatively quickly we had quite a lot of interest from the government of Zambia, from the government of Senegal, also at the time from the government of Nigeria, some in Kenya. So we had quite a bit of demand. And so we could select and focus on implementing the first ones. And the first one was actually Zambia, then followed by Senegal overall. Next slide, please. If I try to summarize and maybe share with you some of the lessons learned, and this is really speaking to what Philip was talking about in terms of how actual reform translates into real outcomes on the ground. This one is not going to come as a surprise to anyone, but I just want to re-emphasize it, but the political economy is key. You would think that for something as straightforward and simple as, hey, you have good solar resources, why don't you put some solar PV if you have blackouts and you need electricity? Sure. Yes, it looks simple, but actually the political economy still reigns supreme. Let me just give you two examples to illustrate the point very clearly. In one of the countries where we were having discussions with the government, the issue came about of, what about our local, domestic, national private sector? They were not really very keen for big auctions that would be conducted by the World Bank Group, that would obviously favor international players, because you have a pre-qualification process and you're asking people to show their credentials, etc. And that would perhaps leave the local private sector excluded. So we needed to figure out a way of making this work. And this is kind of, if you stop and think about it, this is a fairly legitimate demand. In another, to give you another example, for those types of projects to work, and even though solar PV is a relatively straightforward technology with a short construction time, etc., you still need a lot of things to happen sequentially for this thing to happen. So I recall in one of the countries where we were implementing scaling solar, everything almost came to a stop simply because someone at the level of the tax authorities or the local revenue tax service simply wanted to make an interpretation of tax rules that was not the one that the investors had in mind. And so, for example, that required to be unlocked. What I'm trying to say here is that you need everyone to be aligned, and you need everyone to play their part. And even for something as simple as solar PV, quote unquote simple, it's not simple, but it's simpler than many other things. This is not a gas to power project where you need to figure out bringing gas pipeline, etc. But nonetheless, even for those, you probably needed between 30 to 50 stakeholders to all align and make it happen. The second one, this one is pretty straightforward, but if you step back, we did not invent anything in scaling solar. We did not come up with anything that is new or original. People were doing auctions way before we came here. Project preparation is something that for a number of participants here are extremely familiar with. Providing balanced contracts, again, is not something which is crazily innovative. You just go and do a bit of research and get a good law firm, and then you try to have a process whereby you get it. So it's really not about having some idea. And actually, one of the big lessons that we've learned is that when you're trying to innovate, sometimes it's best to recycle, replicate, reuse what has worked elsewhere, start from an existing basis so that you can limit the implementation and execution risk. The third one, and I think Philip also mentioned it, is that we keep always talking about private investors, but let's all remember that private investors have their own interests, their own strategies, and their own stakeholders to whom they report. They have shareholders and they have boards. Whatever it is that we in the development community want them to be doing, they would only do it if it aligns at that moment in time with their strategies overall. And what I can share with you, for example, is that we lived this through scaling solar. In the first Zambia auction, believe it or not, when we issued the expression of interest, we had 42 firms that pre-qualified, 42. So you had quite a lot of interest. In one of the latest ones that we're doing in another country, where we actually awarded it literally a year and a half ago, we ended up with 2 bidders only. What changed? Well, what changed is that we had COVID, and then we had the European energy crisis in 2022, and the world is different in 2024 than it was in 2014. And so, for example, in the energy sector, what we have seen, and this is a trend that is persisting to this date, is that we have seen a lot of the major investors refocus on their core markets, right? And stop pursuing growth in emerging markets, or at least to refocus on a much limited set of markets. So we always have to keep that in mind, that the private investors have their own play. The fourth one, this one is going to be trivial, but it's still worth mentioning, is that even though we felt that we had everything well lined up and we were conservatives in terms of timelines, well, things take time. Things take way more time than we were anticipating. And so this has to be built into our collective thinking, because we need to give things time. It doesn't just happen like that. It may take a year for a decision to mature. And then even in implementation phase, you need to add a buffer, and then you can double that buffer, and then you might still not get there. But we have to be patient. And the last one, which is bringing all of this together, is that timing is everything. Back in 2014-15, when we launched Scaling Solar, there was interest for Africa. Interest rates were low, the macro was favorable, people were pursuing growth in emerging markets, and so we were able to succeed initially. Today, we're living in a very different environment. And so if we try to do the same thing today, we would probably have to go about it differently, because what works, or the solution that works at a certain moment in time, may just not work 2 or 3 years later overall. And so we have to keep that in mind. With that, I'll stop here, and obviously very happy to provide more in the Q&A session.
Thank you very much, Yasser. That's very interesting, in particular the lessons learned. Thanks a lot for sharing your experience. I'd like to move now to the Q&A section. First question comes from Berat Taki. Can you explain more on sequencing reforms? What exactly to sequence? Philip, I assume that one is for you.
Yeah, no, thank you. Thank you very much for that. I think sequencing is really 2 things. So it's sequencing in the sense of understanding where there is credible investor interest, where there is sufficient political commitment. And so that's kind of a strategic sequencing approach that prioritizing business environment reform initiatives that fully recognize this dual requirement. So we've kind of highlighted that without that, you know, business environment reform will not be as effective as it could be. So if we want to make business environment reform, as effective as possible, we need to sequencing it in order to capture that, the interests on the ground and the political will. So that's one form of sequencing. The other form of sequencing is similar to the Vietnam example, where laying the groundwork prior to actually beginning to attract the investors. So hopefully that helps. So the sequencing logic captured in the Vietnam example of building the appropriate foundations before investment, and sequencing logic, for example, in South Africa, where the reform momentum only accelerated when there was an acute energy crisis and political alignment, creating the right window for reform. I hope that helps.
Thank you, Philip. And then Jeffrey Chelsky from the World Bank provides synergies to reforming the World Bank Group country private sector diagnostic. And Jeffrey, as you offered to come in here, we would take that offer. So if you could just unmute yourself.
Okay, does that work?
It works.
Oh, excellent. So actually, I'll be very brief. So we recently changed our country private sector diagnostic. In many ways, a lot of the issues that Philip raised are explicitly the issues we addressed. So we actually take a private investor perspective in identifying the constraints to private investment. And there we don't differentiate between domestic and foreign investors. So we're, by doing that, we implicitly address de facto constraints rather than de jure constraints. We come up with we do it at the sector level, so it's at the subsector level, and we try to come up with no more than 5 to 7 concrete recommendations that are very action oriented. And in doing that, we really focus on things that governments can do now, which addresses the political feasibility issue. If we know something's politically feasible, we're not going to recommend it. And the other thing we do, and this is the last point I'll make, is we stay away from any recommendations that have a fiscal impact. So this is, the point about MDBs not being about funding, but focusing more on reform. We're not doing a full medium-term sector development strategy, but our sense is we want to answer the question, what can government do now that doesn't cost a lot of money, that can remove things that are discouraging private investors? So rather than trying to incentivize them, we're trying to get rid of the things that are in their way. Lots of examples. As I said, 4 are published. You can find them on the bank or the IC website. And next week we will launch the Morocco one, and there's another 20 or so. And if at any point in time do you want to know more, happy to answer anyone's questions. But we're easy to find.
Thank you very much. And please feel also invited to put the link in the chat. I think that's very relevant for many of us. So thanks for sharing. And next question is from Arshanel, focusing on Malawi. What key evidence gaps remain in understanding how business environment reforms translate into private investment in low-income countries? I would start with you, Philip, but Yasser, please feel also free to come in.
Yeah, thanks very much. I mean, that's a complex one, and we deliberately kind of chose middle-income countries where we could see, very tangible links between business environment reform and private capital mobilization. And I say that with all due, caution and respect, because the reality is that in lower income countries and low income countries, it is more complex to link business environment reform and private capital flows and the successes to what we understood when we did our work was the success stories are less, and it's a lot more complex. And you tend to also have the the legacy of some of the more counterproductive type business environment reforms, where essentially some of the mistakes in the past were building white elephants in markets or countries that or building the Rolls-Royce in terms of policy or stock exchanges or whatever it was that it just wasn't aligned with the realities of investment flows and investment attractiveness for those local markets. And so we have, I think it's a key challenge, and it's a very important point to highlight in terms of how do we make business environment reform more effective to tackle the challenges of investment flows to really low income countries and LDCs. I'll pass that hot potato over to Yasser, but
no, it's a complicated one, and speaking because here the question was about Malawi, and this is a country I know a few things about. I'm going to speak mostly from the energy side of things overall, because that's more my area of expertise. I think lower income countries suffer from also the fact that they're perhaps less visible on the international scale. And so in some cases, what we saw is that some good communication efforts would help first and foremost put the country a little bit on the map overall. So I think that there's this part of raising above kind of the noise or the din overall. And again, we have to be careful here, because low income per se may not be necessarily the driving factor. A lot of people in the private sector, they think more in terms of scale, right? So if a country is low income but has 100 million population, here I'm thinking about our experiences, for example, in Ethiopia, you would see a lot of people having interest in serving 100 million people market overall. And so what I'm trying to say here is that you have this first building block, which is the communication part of it, because you may do some reforms, for example, or try to open your energy sector to private investment, which is something that Malawi, for example, did by running some auctions in solar PV. This is also something which is happening right now in Malawi in the hydropower sector right now. Well, and we are working on that. But you have this first part, which is the communication, I would say. The second part, I think, is how do you provide the investors with, and this is something that we've been hearing from the investors very, very strongly and very clearly, which is we need scale and medium-term visibility. In the energy sector, just to make it very simple, very few people are interested in holding a 20 or 30 or 40 or even 100 megawatt asset in a given country. That doesn't make sense to them. What they want is they want visibility on a programmatic approach for, say, the next 4 or 5 years, because for the private investor to enter a country, and even more so a low-income country, it has an initial establishment cost. You need to go there, you need to open an office, you need to send someone there, you need to put them there, you need to start learning the context of the country. And that doesn't make sense to do it for just one project. So what we need is sustain a form of continuity and providing people with visibility. And what we notice is that when governments achieve that, so they do the reform, they communicate on it, and they give investors a medium-term horizon, we are going to be running auctions for renewable energy, but not for 1, 2, or 3 projects. We're going to run them for 20 projects over the next 20 years. That's where you may start to see the flows coming overall. But even if you do that, your timing has to be right. And the incentives that you will need to provide those investors will have to be slightly different than in other contexts.
Thank you very much, Philip and Yasser. I don't see further questions, so I take the freedom to ask one myself. For me, coming from a development agency, one key takeaway is that development partners need to technical and financial assistance much more closely, reflecting, for instance, on the South Africa example. Could you elaborate a bit on why this is important and how it can be done effectively in practice? And Philip, you can start. Yasser, you can add.
Yeah, no, I think, I mean, this is it's at the heart of the what we're trying to show here is that essentially this technical assistance in terms of enabling actors. So it really depends on if we're talking about SMEs or financial institutions or private equity players. That technical assistance is critical for sure to enable more financing flows. We see it, particularly in the DFI space, with significant amount of technical assistance going into support through programs such as Boost Africa. Some of the venture capital firms that are now building innovative businesses in an African context. Those venture capital firms would not be as resilient or as aligned with best practices in enabling capital flows from limited partners from markets such as Europe and the US, had it not been for those technical assistance implementations. So, I strongly agree with the point that you make, Tobias, that these 2 points come hand in hand.
Yeah, I mean, if I can share just like a practical experience, is that to a large extent, I think the financing part is the easy part, right? To some extent, it's a bit like build it and they will come. I have to say, I've spent more than 20 years doing energy project finance in emerging markets, generally speaking. I mean, actually, I'm being a bit generous. I mean, it's closer to 25 years now. I've been doing that. I have to say, in 25 years, I'm still yet to see one single good, well-structured project that could not find finance. They always find finance in general. But the key is that it has to be a good project. And the financing will come either from, in the first approximation or in first instance from development finance institutions or MDBs. Then in a couple of cases, what you will find then commercial financing might come, or they may have hybrid financing coming, or you may have sovereign wealth funds coming. Again, the universe is pretty large, but the key is really this technical assistance and how do you design a good project? Because you can go to markets that are extremely liquid, where you have a lot of financing flow, but something that is not well designed will struggle to attract finance. And conversely, again, my personal experience is that even in really what we call in World Bank Group fragile and conflict-affected contexts, once you manage to get the reforms in place, you have an enabling environment that provides the investors with some modicum level of transparency and security. Once you have the technical assistance so that the government counterpart can engage with the private sector in good faith, because this one, I'll come back to it, it's a very important point. At the end of the day, the financing will always come overall. So I would insist on the two being linked, obviously, because you have to walk we have to walk on 2 feet. But this is the key and the crucial part, the technical assistance. And in particular, if I may share with you, just like, and this is probably more on an anecdotal basis, but in the energy side or in the energy space in particular, we have always to remember that in a number of cases, you have a massive asymmetry of experience and information between, say, government counterparts and the private investors. A private investor will show up to a meeting with their fancy lawyers. They will be all well prepared. They will have a big team overall. And this would be perhaps, their 100th contract that they are negotiating, because they have done this elsewhere. They have done it in OECD markets or in other markets overall. This is where the part of the technical assistance and the support becomes really important to build the capacity on the other side. And this is where we've seen some interventions being widely successful, providing, for example, a facility for high quality legal support and assistance to, say, government officials. That kind of like evens the field out. Having some development finance institutions or MDBs providing a technical assistance package also helps close some of the gaps. How do you know whether the contract that is being offered to you by the private investor is balanced or not? How do you know whether the royalty rate is the right one? How do you know whether your tariff is competitive? All of that requires support. And I think that in a number of cases, what I have noticed is that things don't happen because on the government side of things, officials are held accountable and they may just be concerned and afraid in terms of doing something that may come back and bite them later on, especially in highly politicized environments and where you have political transitions happening. And so closing that kind of knowledge gap and that confidence and trust gap is important. I think this is where the technical assistance has a complete role to play here.
Thank you very much to both of you. Then we have a few questions from Stepanka from the Food and Agriculture Organization, and I just collect them. So the first one is on climate resilience, which is a long-term investment without clear rewards and a public good. What type of investor would be interested in this kind of long-term venture without clear returns? So the first question. Then the second from Stepanka, Yasser mentioned domestic private sector, which is typically not as well resourced as foreign or international investors. However, domestic investors are important from a political and social perspective. How can governments ensure that domestic investors can also play a role in the investment? I think that's a very good one. And the last one from her, following the investment, is an exit strategy planned for the private investor? Can the project be taken over by the government or domestic stakeholders? So 3 questions. The first on climate resilience as a long-term investment without clear rewards. Then the second on domestic private sector and how to better include domestic private sector. And the third one on exit strategies and project to be taken over by government or domestic stakeholders. Who wants to start? Philip.
Yeah, no, happy to jump in. So I think, absolutely an excellent point on, what type of investors will be interested in unpredictable returns and an uncertain environment, long-term returns from climate. And so this is one of the recommendations that we kind of put together as one where we believe there's a lot of work that still needs to be done from multiple stakeholders. Essentially, the recommendation here is not so much what we can improve relative to practical case examples, but more around recognizing the fact that indeed, there is a problem here, that mobilization for climate resilience needs a different way of thinking. And our recommendation here was that, actually actors need to spend a bit more time thinking about this one and coming up exactly to your point with some ideas and technical solutions as to how we can make climate resilience more of an attractive opportunity for long-term investors through business environment reform. So what are those business environment reform tools? And so I'll have to say that, at this point, I don't think those tools are well defined enough. So that is something that we still need to work on collectively. The other one with regards to, domestic investors playing a role, I fully agree. And, this is one of the recommendations we made. And, we put forward an example that, it's, some of the problems are very transparent. For instance, from the DFI side, I wear a DFI hat, have allocated to private market funds in emerging markets for many years on behalf of DFIs. And, the issues with capital flows into private market funds, for example, private equity, infrastructure, venture capital from the local pension players and domestic investors is not so much one of, are they allowed to invest in these asset classes? Many of them are allowed to, and the regulatory environment is there. It's more of one of understanding the blockages which is one of our recommendations here. And so it's more about actually what is the problems that those local investors face, and oftentimes it's a question of pension fund trustee education and understanding of what does it mean to be a private market investor versus a listed equity investor, and how that can be of benefit to pension fund returns over the longer term, and also help stimulate innovation in local economies. And so I think it's about matching and understanding those domestic investors a lot better, and matching their real issues to business environment reform or technical assistance or activities that help encourage those capital flows. But really sitting down and understanding them better, which is one of our recommendations. And then, I think with regards to exits, it really depends on what we're talking about, whether it's infrastructure, private equity investments, venture investments. But I think there's a lot that can be done in terms of market depth. We mentioned, for instance, in Southeast Asia, one of the problems with getting exits is that we have a shallow domestic stock market. It needs to be somehow deepened, which means more participation in those markets. One of the biggest problems we know right now from all of the capital that's flowed from development finance institutions into private markets in Africa, for instance, is the lack of exits and distributions back to investors. And so, I think we're seeing that a significant reliance on the private market and the private sector to provide exits for some of these assets is simply not panning out to be a real opportunity set. So I do think you're right in pointing out, how can we provide more liquidity solutions to investors? Some of it, I think, lies with the development community itself, having a think about how we can be more active participants in creating liquidity through secondary transactions and secondary markets, which seem to work well in the US and Europe, but are blocked in markets like Africa because of our very long-term views and our unwillingness to take discounts on assets. But it's a great question. I'm not particularly sure that government is the right route to provide exits for private sector players. But yeah, maybe Yasser has a different point of view.
No, not a different point of view, but maybe just some illustrations. So on climate resilience, I'm not going to repeat what Philip said. Yeah, this is a hard issue right now. The way we are thinking about it at the World Bank Group is to simply accept the fact that if something is not necessarily financially attractive for a financial investor, then you need some blended finance and you need some blended capital so that the private investor can focus on doing what they know how to do best, which is deliver a technical solution. And then what we will need is you will need people like us in the development world, and maybe in some cases also some sovereign. We are seeing some sovereign wealth funds, etc., who have a bit more of a development mandate come also to the table and then provide blended finance overall. And so these are structures that we're playing with in terms of we are seeing, for example, investment funds that are being set up where some investors in the fund agree to cap their returns, right? For example, so they would agree to a fixed return that will be no more than X%, given who they are, and that they would allow deliberately private investors to capture the return that they are not getting, for example. Or you have situations where, for example, you would provide an insurance or a guarantee to an investor up to a certain level of losses, for example. So you have some ways of doing that, but that remains a hard question. In terms of the domestic private sector, this one to me is absolutely key. In my experience, if we don't find ways of bringing the private sector to the table, then the political economy turns really badly against you, because then the private sector investment becomes seen as, it is just like a way for foreigners to come and take over our assets. So we have to make an effort in terms of bringing them to the table. How? Luckily, unfortunately, there's many ways of doing that overall. So just to speak about some of the stuff that we have seen and we have done, when you do your auction, for example, you can give, for example, some bonus points, or you can give a premium to someone who is partnering with a local investor, for example. So when you are scoring the bids, from a technical and financial basis, if someone has made the effort of having a local partner, for example, you would give them some significant bonus points. You also have to prep the domestic private sector. So, for example, I remember myself going in and engaging, for example, with chambers of commerce in various countries in Africa ahead of scaling solar auctions, to talk to them, to encourage them, to explain why this might be something of interest to them overall. You could also, in the design of the auctions themselves, reserve a certain portion for the domestic private sector. It may be held by the government in the first part, and then transferred back. To give you an example, in all of the scaling solar auctions that we've done in Zambia or in Senegal, the government always had a stake of 20%, which was with the explicit intent to be resold later on to domestic investors. So they got a 20% stake because we want them to have a stake. What we have seen in some agreements, for example, is that the private investor would be encouraged to list partially the project if there is a domestic stock market, for example, but there is a strong incentive for them to do a partial IPO by a certain date, right? And you can think of a number of incentives to allow them to do that overall. In some cases, you can even make it an obligation if you have a real stock market overall. So there's a couple of mechanisms that one can think of to encourage domestic private sector participation, but that remains something that is essential and often overlooked. On exits, Philip, I agree with you. Government should not necessarily be the exit overall. But that's where one needs to think about, pension funds in the country, needs to think about how you build those opportunities, whether you create some financing structures such as, investment trusts or, reinvestment vehicles overall, whereby some assets that are de-risked, for example, and in particular, because I'm coming from the infrastructure background, if you think about it, once something is built and is operating and has a few years of track record, that can be a really good asset that's delivering not huge returns, but fairly stable and predictable returns. And so that could be of interest to pension funds, that could be of interest to insurance companies. They are also overlooked in a couple of markets. And this is where a number of things can happen. You can change your insurance rules so that insurers can invest carefully in some projects, etc. And that can create those exit options later on for the private sector. But as Philip was mentioning, this is something we're also hearing a lot from private investors, that there is a missing gap here in that area, because people may not want to stay for 20 years in a given place. And that is certainly a factor.
Thank you very much, Yasser and Philip. We are over time. There's one question left from Ernest on price of electricity is not fixed in a certain project, and he provided a link. I would suggest, as we do not have time and I do not know the project, that you get in touch with us, and myself, Yasser and Philip can have a look. I hope that's okay for you. Thank you very much for bearing with us. Big thanks to our speakers, Philip, Yasser, also for Ela, for the support in the background. Thanks to all participants for joining. For me, the participation of the domestic private sector, that was something that was mentioned frequently, and that is a key takeaway for myself. Once again, thank you very much, and see and hear you soon.
Thank you, everyone.
Thank you, Tobias. Thank you, Yasser. Thanks, everyone. Bye-bye.
Bye-bye.